Colm, good morning.
Good morning, James.
Thank you very much for doing this. As I said before, we had Oliver on before, but I think that was a while ago. So I'm going to get you, if you don't mind, just sort of rehash the story on ICG Enterprise. And just introduce what the fund's doing and what it's trying to achieve, please.
Absolutely. Okay, well, listen, thank you very much, James, for the opportunity. And we always like the opportunity to tell our story and also just to tell the story a little bit about the sector as a whole. So maybe just to start, maybe just to set the scene on the sector with the next slide. I'm just going to take the audience through a handful of slides, just as I say, just to set the scene, and then we can go on to some Q&A. So listed private equity. I suppose, first of all, let's talk a little bit about private equity itself. Private equity, for many of the world's largest investors, the most sort of unconstrained, if you like, by resources, the largest sovereign wealth funds, largest global pension schemes, lots of them have been increasing their allocation to this asset class. And there's various different reasons, not least of which is expectations around performance, which you can see on the chart here, where both global and US buyouts are expected to outperform most asset classes, according to a BlackRock survey. A lot of investors like the model. They like the active ownership. It's a very aligned structure between the owners of a business and the people who manage and operate it. We've said on the slide here, it's no longer alternative. What we mean by that is it's grown markedly. So since the global financial crisis, the private equity market has tripled in size, also reflecting its attractiveness to the world's largest investors. Now, there's an issue with it, and that is that it's quite difficult to access for a regular investor unless you happen to be incredibly well off. Why is that? Minimum commitment sizes to funds. There's a huge administrative burden. Things like tax reporting is very complicated. You've got to manage cash. And it's also very difficult to access the very best managers. And that's where listed private equity comes in, allowing retail investors and small institutional investors access to this attractive asset class. And we think that listed private equity actually has a few additional benefits as well. Investors coming into listed private equity vehicles typically benefit from a mature portfolio. In contrast to those who start investing in funds, you're not waiting around for a long time for your money to be deployed. And also you've got visibility over the constituency of that portfolio and some of its features. We also think the closed-ended structure, we've just obviously been talking in that context about some of your earlier stories. We think for a relatively illiquid asset class, the closed-ended structure is obviously very well suited to managing, especially during periods of volatility. But now to tell you a little bit more about ICG Enterprise and how we address the market and how we think we're differentiated. I think just to divide it up really into three different things. We think our platform is differentiated, the way we structure our team is differentiated, and we think we have a differentiated strategy. We are the oldest listed private equity vehicle, so formed in 1981. It was formed originally with around 20 million pounds. We haven't really been back to the market at all since, and that's grown over time to well over £1 billion, so at portfolio of about 1.4 billion. Just moving on now to discuss a little bit about our team. Actually, before that, I'll just say a few words about the platform. We are part of ICG PLC, which some of you will be familiar with. It's a large alternatives asset manager with over $70 billion of assets under management. We have a global reach. We have access to lots of different institutional knowledge. We benefit from being locals in lots of different markets, and that really helps our business and our investment strategy. Just moving on to the team on the next slide. I think one of the other things that is differentiated about our offering is that we've invested heavily in a dedicated team. Myself, Oliver, Lisa form the IC. We are devoted to ICG Enterprise Trust. And you see my other three colleagues there who are also part of the investment team. But we We also benefit from, as I say, talking about the platform, that the wider support from within ICG, access to significant institutional knowledge and bandwidth and resources, which informs our decision-making, helps our operations, and we believe ultimately feeds through into strong investment returns. We're a very experienced team. Our investment committee has over 20 years private equity experience. We've a broad-based experience across both direct and fund investments, and different professional backgrounds. So Oliver started management consultancy. I originally trained as an accountant. So we've got various different skills within the team, and we bring all those different perspectives to our decision making. Now, to just focus a little bit on strategy, the thing I always like to say to people is, I think sometimes people tend to think about private equity investing as a sort of homogenous approach. But just like public market investing, there's lots of different ways to address the market. And we've just seen, for example, how Chrysalis invest in private assets. What we do is quite different. We're very focused on buyouts. So that's investing in companies typically that are EBITDA positive, cash generative, typically in mature markets, mature business models, rather than investing in more speculative asset classes like venture capital or growth equity. So we don't think there's anything wrong with investing in venture capital, but it's just we like the focus due to our very sort of risk, focus on risk-adjusted returns. We only invest in developed private equity markets. That's typically Western Europe and the United States. We find those markets, they're more mature. They have a better private equity infrastructure. So things like legal systems work better for the asset class. But also, as we're manager-led, what we tend to find is it tends to be where you get the strongest and most experienced managers. Within that market, we focus on mid-market and larger deals. Again, you'll hear some of our peers, they prefer to go for more kind of early stage, first-time funds, slightly more esoteric strategies. We actually think that there's tremendous value in the more mature part of the market, investing with managers that have experience of managing through cycles. So very often we're asked, for example, about current interest rate environment. We take confidence from investing in managers who have been through this before, who have a kind of muscle memory about how to behave during crises and know what to do. We also think that the kinds of companies we ultimately end up investing in, they tend to have more resilient business models, tends to attract stronger management teams, and ultimately, we believe, delivers a optimal risk-adjusted return profile. Related to that is a focus on partnering with top-tier managers. So again, it's very easy to be seduced by new managers who haven't been through crises. Sometimes we actually quite like managers who've made mistakes. We take comfort from the fact that they have learned from them, as opposed to backing people who've almost never been through a difficult environment. Typically, our managers have been around multiple cycles. A lot of them are kind of brand names within our industry. And we tend to back those that are relatively difficult to access, the leading managers, both in the US and Europe. And then within that quite focused universe, finally, the one of the sort of overarching theme in all of the strategies and companies we seek to invest in is the concept of defensive growth. And essentially, that is backing companies and strategies which are able to grow even during difficult and volatile economic environments. That's typically companies that benefit from long-term trends that aren't correlated with fluctuations in GDP. And we'll go on in a second to give you some examples, some real-world examples. The next slide shows you an overview of what that strategy has produced in terms of our portfolio composition. Just a few things to draw your attention to. It's a pretty balanced geographical exposure between our core markets, between North America and Europe. That's a bit of a change over the last 5-6 years. Historically, we were predominantly Europe focused. We decided to use the ICG network to expand to the US, and that's been very successful in terms of being able to access the best managers and in terms of growing, in terms of being accretive to our investment returns. We've got a balanced sector exposure. As you'll see in a second, the way we structure the portfolio means that within these sectors, we've diligenced companies. So when people see, for example, that our larger sectors are things like TMT, technology, it's obviously been subject to some scrutiny recently, but we're investing in a very different type of technology to many other vehicles you might be familiar with. So these companies are typically all cash generative. They have high margins. They're relatively mature. So there's still technology and there's still growth, but it's underpinned by a very resilient business model. Similarly, sectors like consumer, within the sectors, we've got relatively high concentration in certain companies, which we've diligenced, and we focus on the very defensive subsegments of those sectors. So technology are mature companies that are cash generative, as opposed to investing in more speculative revenue multiple type companies. Similarly, within the consumer sector, we're focused on companies that have very defensive attributes. So you won't see very much in the way of sort of highly cyclical consumer companies. And then on the portfolio construction, which I think is where we like to differentiate relative to many of our peers, in the world of listed private equity, you have some vehicles that are very concentrated, and they're concentrated not just by single companies, but also sometimes by sector. And then you've got very, very diversified portfolio construction as well. So effectively, where some of our peers are, again, nothing wrong with this, it's just a different way of approaching it, but they're more like indices of the private equity market, where individual company performance doesn't make much of a difference. We sit in between. So what we have, our top 10 companies are about 20% of our portfolio, top 30 is about just a little under 40%, top 50 a little under 50%. And that, of course, ebbs and flows as things are acquired and realized. The way we think about this is the performance of our largest exposures, which you can see on the chart here. It makes a difference to our overall NAV performance, but we're not taking what we would consider to be excessive single company or single sector risk. So it's a very balanced approach to risk management. Just moving on to the next slide, just wanted to spend some time just putting that defensive growth focus into context. And what are we looking for in these top companies? And many of them, I always think, they're reassuringly, they're boring, but they grow. We look for companies that have strong market positions. So, some of these businesses, like we just had a partial realization of IRI, effectively operates in a global duopoly. Or we've recently acquired deal QuotedData Connector. That's the 6th biggest player globally in its sector, which is consumer experience, so helping companies interface with their customers. So companies that have these strong market positions are attractive to us. Similarly, businesses with mission critical services. So we like a lot of these companies where they are critical to their customers, but very often they're not a significant proportion of the cost base. So businesses like Minimax, it supplies fire protection components. Well, those things are mandated by law and regulation. So if you think about, for example, a large airport, irrespective of the volume of flights, we saw this during COVID when airports were operating at a fraction of their normal capacity, but their fire protection systems still needed to be serviced, maintained, and replaced. So that's a really good example of a business doing something which is mission critical, but also where its technical competency, its ability to innovate is critically important. We like companies that have the ability to pass on price increases. So sometimes that's through a structural feature. So their contracts are index linked, for example, or it's because of the demand profile within the particular market sector in which they operate. So for example, we'll talk in a second about Endeavour Schools, a recent realization. Obviously, it's a schools business. You won't be surprised to learn its largest cost is labor. So it saw an increase in its cost base, but it was able to pass that on because of the underlying strength of demand, the inelasticity of demand for its services. And then we also like companies that have structurally high margins. So you see here a number of software businesses, payments businesses. So companies which are able, which have the ability to take high margins, and that obviously provides significant buffer if their cost base is moving around. So that just gives you a little sort of flavor of the kind of characteristics in obviously very high level, but the kind of characteristics of the companies that we seek to invest in. And the performance of these companies, you can see here, we're aiming for growth, but we're also aiming for consistency. And you can see that track record of our top 30 companies at various different year ends and our recent half year. And what you can see here is that we are much less volatile than the FTSE All-Share constituents. Some years they fall very heavily, they rise, correspondingly they rise the next year, whereas our performance is much more steady and consistent. But as you can see, the recent growth has been very strong, with our top 30 EBITDA growing 26% over the last 12 months. And that represents a really strong bounce back from the COVID pandemic. And actually we saw the strength of the model even during the COVID pandemic, when obviously it was an unprecedented time of volatility. Nevertheless, the companies continued to grow. And what we also saw was some of those companies that were particularly challenged because of that private equity model, because of that active management style, they were able to weather the crisis and emerge stronger. And that's a really good segue into the next slide. We like good news. And Endeavour Schools, second largest portfolio company at October. It was realized a few days after our, it was realized a few weeks ago. Endeavour it's a fantastic case study of what we look for, and I think more generally for private equity. So Endeavour is a schools business. One of the things I love about it is it's pretty easy to explain because I think pretty much all of us have been to a school. It focuses on early years education, in particular Montessori education, but also what we would call in the UK primary schools, in the US elementary schools. And the thesis here is very much centered around identifying an attractive industry. So it has some of those very attractive demand features, which we've just discussed, but also one that's very fragmented. So it's mostly single sites at the moment in the US, but actually there's an increasing advantage to schools grouping together. Certainly I'm in my 40s and schools now are very different. They've much different sort of demands in terms of things like IT, cybersecurity. It's a very different world, and there are greater advantages to pooling together. So Endeavour was seeking to address a fragmented market. It started off with a little over 30 sites. It says on the slide 60. It's actually now grown to over 90 schools in the last few weeks through some acquisitions. It's broadened its geographical footprint across the US, and our manager Leeds, who had experience in this sector, grew it to a size where it became very attractive to an acquirer who wanted, a private equity acquirer who wanted to take the platform and grow it still further. We made a very strong return from this investment. It's been a very good result for us. And it's, I think, a really good exemplar of what we mean by defensive growth, and also the importance of backing managers. In this case, a manager you've probably never heard of, Leeds Equity, which has especially strong domain expertise. I'd also like to give you a little case study of a newer investment. This may be familiar to some of you, actually, in that some of its brands are quite popular with British consumers, with British tourists to France. So the Eurocamp brand in particular is very well known. This is an investment in a business called European Camping Group. It pretty much does exactly what it says on the tin. It operates holiday parks, camping sites. And I think it's, again, a reminder of a number of the themes I've already addressed. It was a very strong recovery from the COVID pandemic. As you can imagine, during the height of the pandemic, most of these facilities were closed. But we took comfort in investing alongside a manager, PAI, which had considerable sector experience. Any of you who've owned our shares or followed us in the past will remember a very successful investment in Roompot, which is a quite similar business, which operated in the Netherlands. That was actually realized in 2020, just right in the middle of the pandemic, when everything was closed up. These businesses, as I say, PAI have tremendous experience managing these businesses. It's also something where, again, the ICG footprint was very helpful to us. ICG's direct investment team used to manage a similar business in the UK. And that was really helpful to get us up the curve to help us understand the industry. So a combination of that ICG knowledge and backing a manager in PAI who really understood the sector made this particularly attractive to us. It's a very resilient market. Very often, even in times of recession, people still want to go on holiday and will often look for a better value alternative to their traditional holiday. And sometimes that can be camping or they're very well run, very attractively situated holiday parks. And there's lots of drivers for growth. So just like with Endeavour, it's a very fragmented industry, so there's significant potential for M&A. And actually, the manager has just executed a very significant add-on, and it's also trading. We understand it's trading very well at the moment. There's been a really strong recovery in travel, so it's a business that we're a relatively new investment, but one that we're very optimistic about its future trajectory. I think just to sort of finish off my initial introduction, I just wanted to obviously touch on one of the most important things for shareholders and potential shareholders, which is returns. So as you can see, based on our most recently released results, we've generated over the last 12 months portfolio return of a little under 14%. That's in local currency. And you take account of currency and some of the other balance sheet activity, that brings you to a NAV per share total return growth of a little under 20%. And over the 5-year period, these numbers, by the way, are annualized. You can see the portfolio grew an average of 20%, and that resulted in NAV per share growth of 17.6%. But one of the things we're most proud of is not just the headline numbers, which we think compare well, but it's the way in which we've generated those returns in a very consistent way. So you can see in the chart on the right that historically NAV has grown in most quarters. You can only see there's 2 periods where it contracted, one of which was really in the height of the COVID pandemic, the first quarter of 2020. But it's been a very consistent growth pattern. And that reflects, the way our strategy works. So we're really looking for, as I say, that defensive growth strategy gives you that profile. It's also those returns have been supported by a progressive dividend policy. So we have a long track record over the last 5 years of increasing the dividend, and also through a recently launched share buyback program as well. And finally, the final slide just gives you a summary. I won't go through all these numbers, but the performance over the last 5 years, various different time periods. And you can see that the performance against the listed markets in particular has been especially strong in terms of NAV per share. There has been, of course, some noise over the last few months with our discount, which has impacted our share price total return. But we think that as we look to the future, we think the portfolio is in good shape. As I say, we've been very focused on building a defensive portfolio, and it's one which, based on recent track record, has been growing strongly. And so we look forward to seeing what the future brings. And I think with that, it's probably a good time to go on to questions, James.
Good. That's all. That's quite a useful roundup. Thank you very much for that, I think. So I'm going to fly around a bit. So let's go, not that far back. Right, let's start here. Not here. Next one. There. One of the questions at the beginning was, given you sort of focus on defensive growth, why would you not do growth equity as well as kind of private equity?
So, well, growth equity tends to be investing in more speculative, might be the wrong.
I'm afraid we've lost your sound again.
Wrong word, but more volatile. We think our particular cash generative companies. Mm-hmm. Oh, I'm so sorry. There seems to be an unstable internet connection. Is that got better?
Yeah, that's better now. So start again. So I'll ask the question again. So why not growth equity?
So we we continue to believe that the best risk-adjusted returns, and by that we try to minimize loss rates, minimize volatility, continue to be in the larger buyout segment. We prefer the risk profile from more mature businesses, whereas growth equity tends to be investing in more speculative companies. So typically, not always, but a lot of growth equity investments tend to be in companies that aren't EBITDA positive, and therefore, particularly in a higher interest rate environment, that will cause much greater volatility. So it's not that we think, like, personally, I see great value in lots of the ancillary asset classes, venture, growth equity. They all do different things. But I think our particular proposition of offering a very defensive approach to private markets investing is best served by that focus on buyouts.
Okay, thank you. Now, looking at the distribution of the portfolio, one of the questions here was just asking, you've got a fair bit here in North America, it's the sort of largest exposure.
Yeah.
Do you expect that allocation to change over the next sort of couple of years as valuations maybe become more attractive outside the US?
So typically, we're very manager-led in terms of we don't look at a fund and go, we have to do this to keep up a particular geographic allocation. But what you tend to find is that we will end up being roughly market weighted. So we've built up the US portfolio over the last 5 or 6 years. So it was around 14% back in 2016. It's now a little under 50%. I would say that the best way to think of it is over time, we are likely to be roughly 50-50 between the two large buyout markets, between North America and Europe, roughly. And there will always be a small allocation to some other markets. So some of our managers have small pockets where they're able to invest, usually in mature economies. So it'd be places like Australia, which we wouldn't focus on, but some of our global, some of our managers have a global mandate, and you'll see small pockets of other. But broadly speaking, the ratio between the two big markets, we expect over time to be roughly 50-50. That ramp up has been driven by a change in strategy, which happened when we moved over to ICG. But the pattern you see now, I don't think is going to markedly change.
Do you think the sector exposure might change? So the question here is asking whether, because you've got quite a lot in sort of software as a service companies, is that something that's likely to continue? Do the valuations of those in the kind of listed market make a difference to whether you invest in them or not?
We look at every co-investment on its merits. I would say software as a service is inherently a very attractive business model for what we're looking to do. So a lot of our larger exposures at the moment are in that sector. So businesses like Visma, we love a business that has 1 million customers, all of no customer concentration whatsoever. And it's a public company, so I'm able to talk about its numbers. It continues to grow year after year. By the way, when I say public company, it's got publicly listed debt, which means that you can see its financial performance is publicly disclosed. We think companies like that, I mean, actually, if anything, the change in valuations presents an opportunity potentially for new investments. I don't think it would necessarily, I don't think there's any sign that we would markedly change our sectoral composition. Because I think these companies will continue, that particular segment will continue to be attractive. And also it's worth noting that some of the fluctuations you see on the public markets, they're much more marked for businesses that are not EBITDA positive. So, I mean, it's obviously sort of, company valuation 101, to the extent the future profits are concentrated further away in the future, obviously rising interest rates has a greater impact on those valuations and those multiples for more speculative long-term growth than it does for companies that are already delivering positive EBITDA and already generating cash.
Okay, thank you. Actually, that kind of leads us into a whole bunch of questions here about valuation, maybe.
Yeah, sure.
So one of the questions is asking specifically whether you think EV/EBITDA multiples, so the relationship between the sort of value of the company and the cash flow it's generating, because they've sort of contracted in the listed market.
Yep.
Do you think that your current discount is a reflection of sort of investors' perception that that's a trend that will happen in the private equity sector?
Yeah, so I mean, more broadly, speculating on why we have a discount, I mean, there's so many different theories, and I've given up trying to guess which is the right one, and I suspect it's probably a combination of different factors. On the valuation point, when we look, so one of the advantages of having a relatively concentrated portfolio is that when we can monitor it quite closely, and when we look at the individual companies, one of the things we noticed was that, you know, during the heady days of 2021, when the market, particularly for things like software, was racing away, and you can see it if you look at the implied multiple from the S&P software index, it was above, in terms of EV/EBITDA, it was flying above 30 times. We didn't see that in 2021 in our portfolio, or in early 22. Managers were seeing significant revenue and EBITDA growth, and they were reflecting that in their valuations, but they weren't typically, you know, on average, were not significantly changing multiples. What's happened since, obviously, is in the listed markets, the multiples have come down. So again, on that S&P software index, it's down almost 10 turns. But our managers didn't put it up to that 30 times level during the very sort of heady days of 21. So to some degree, those valuations have stayed quite stable in terms of multiple. And I think what people didn't notice it during the boom, but then are expecting them to come down more as things have dropped off. So I think it's a relatively complex sort of picture. But as I say, when we look at the individual valuations and we compare them to public markets, we're pretty confident that our managers aren't materially overstating valuations.
Well, that leads us into another question here, really, which is something that we sort of been banging on a bit about, is that I think valuations in the private equity sort of sector are generally quite conservative. So what is the sort of average uplift that you get when something's sold?
Yeah, so we have a very long track record of things being realized at material uplifts. So to give you an example, we had 11 full exits in the last quarter we reported on. There was an average of 33% uplift to the previous carrying value. And there is a long time series of, 25, some year, I think one year we had 38% uplift. So there are significant uplifts when things are realized. And if you look at the vintage portfolio, the age of our portfolio, we don't have a significant number of things that have been hanging around in the cupboard for a long time. So there is a turnover in the portfolio, and when things come out, they're realized typically at a significant premium to previous carrying value.
Okay. So do you actually have an idea of, over the sort of average life of an investment, how much of your return is driven by the sort of underlying EBITDA growth of the company, and how much is kind of multiple expansion?
It's obviously a really important question. It's very, very difficult in practice to measure. The maths of it is sometimes, so typically private equity managers break it down by revenue growth, EBITDA growth, and then deleveraging. In other words, the benefit of paying off that debt obviously gives more value to the equity, and also changes in the multiple. And the maths of it will alter depending on assumptions you make about the order you apply those effects to. So I always think it's a fairly inexact science, which people try to present as a very exact science. Intuitively, most of the gain comes from EBITDA growth. And it comes also from things like we saw with Endeavour. When you make these add-on acquisitions, when you grow the scale of a company, typically you're acquiring the add-ons at a lower multiple than what you can mark the larger platform for. So that it's not just the organic EBITDA growth, it's also the growth you get from building up the scale of a company as well. So it's relatively complex, but I think, over time, the only way to consistently generate growth is to grow revenue and EBITDA.
Okay. And we've got pretty good EBITDA growth of the last couple of periods here. Do you think that will sort of normalize to a more kind of mid-teens number for 2023-24?
Yeah, listen, I think if you think about, so the numbers you can see here, that was H1 23, which is actually based on the year to, in most cases, June 22. It's a little bit confusing because our year end is January 23. So that some of that growth is represents a recovery from the COVID pandemic. So businesses like Endeavour were obviously significantly impacted by COVID. I mean, the Leeds, the manager that we backed, never envisaged a scenario where every single school in the US was going to be closed. And of course, changing for early years education, changing work patterns also meant that it was a pretty slow ramp for people to come back into the schools. So some of this represents some of that unwind, some of that recovery. It's difficult, obviously, to speculate, and I probably get into trouble with my compliance department if I was to overly speculate on exactly where we were going to end up. But I would say we would expect the portfolio to continue to grow. But as I say, I think it would be a stretch to suggest that anything could continue to grow EBITDA 25% every single year. Sorry, that was a bit of a politician's answer, James.
No, I think that's a reasonable answer, to be fair, really. I think it's hard to get visibility to this stuff anyway. Now we've obviously seen quite a lot of volatility in markets. So there are two questions here that are sort of linked. So one is, in periods where markets are falling and investors are nervous, is that a good time to deploy capital? Do you find that actually your managers are deploying capital faster in those sorts of periods? And then on the other side of things, how do you time the exits to make sure that you're sort of capturing the best price you can for things?
Yeah, so I think part of our, just the exits point first, I mean, our model is to back, the world's leading private equity managers. And we say North America and Europe, but that to a large degree is the world's leading managers. And one of the things that they are particularly adept at is optimizing exit timing. And it's obviously a typical hold period for a private equity investment. We can get quicker exits, but it's typically 4 or 5 years, often longer. And we place significant faith in our managers to know their markets, when is the best sort of inflection point to effect a sale. So, Endeavour is a good example. Another private equity firm has bought Endeavour and presumably thinks there is more to go. But Leeds obviously decided that it was the optimal time in their investment life cycle to effect that exit. In terms of the speed of deployment at the moment, I think our managers, again, it's very much a long-term investment strategy. They're looking for things that are not impacted, that are not correlated with the economic cycle. Obviously, most things have some economic impact, but they're looking for companies that benefit from underlying trends. They're the kind of trends that don't change over time. And most of our managers try to deploy in such a way that they are relatively diversified by vintage as well. So I think it's very much what we see is that you obviously have periods where M&A volumes are high and maybe the deployment pace is a bit high, is speeds up in our portfolio. But broadly speaking, most of our managers are looking to deploy relatively evenly. And they're often looking at companies, what they're doing, they're not backing companies that have just come across their desk. They've been tracking things in many cases for 4 or 5 years before actually doing the deal. So I think it's a very, very long-term focused way of investing.
Okay.
And I think it's reflected in relatively, you get peaks and troughs, but we're still seeing deals go through. We're still seeing things being realized.
So you mentioned, I don't think there's a slide in it here, but in terms of your sort of the maturity of the portfolio, you're saying it's younger than normal now. Is that true?
No, I think it's around, it's a little over 3 years is the average hold period of our assets. Obviously, there's always a bias given the realization pattern. You always have a bias towards the more recent vintages, and our most recent RNS gives you the vintage exposure. So 17% was 2022 vintage, 25% is 21. So that's around 40% is in the last 2 years. But when you average it out, it's 3 years, a little over 3 years. Okay. And that's been fairly consistent for most of the time that I've been involved with the vehicle, which is sort of the last 10 years.
Okay, thank you. There's just a couple of questions left actually. So and in fact, these sort of, I can kind of put them together. Sort of the macro environment has obviously been a bit strange. Has inflation made a difference to the sorts of things that you end up buying, or higher interest rates? Has that had an impact?
Yeah, so obviously
themes that you're seeing that maybe play sort of post-COVID that work as well.
Yes, I mean, both are obviously very front of mind. Probably actually, if you go back to the slide, I haven't got my page numbers, the one with the defensive growth attributes, or sorry, characteristics. Slide, yeah, that one.
Yep.
I mean, in some ways, if you think about inflation and interest rates, those characteristics actually, it's not just cyclicality, they also apply for things like inflation. So your ability to pass on price, your ability to maintain margins, very often, there's a very good overlap with defensive growth also means as a pretty good read across, we think, for inflation resilience. And obviously the impact of interest rates is very, very complex. And there are lots of different, so everyone obviously thinks about the impact on the companies and the impact on cash flows. There are also, we've addressed them earlier on, impacts on valuation multiples. So, interest rates have lots of different impacts in various different parts of our portfolio and various different sort of, as I say, it's not just the underlying company's cash flow management, it's also valuations, there's lots of other things. So we think that the kinds of companies that we invest in, they're resilient and they're able to cope with those changes. I think the change in interest rates was, everyone was expecting interest rates to increase. Our managers, we're backing managers that have been around the block, that have been through these cycles. So they have always planned for this to happen. So that's really sort of built into how we think about manager selection and portfolio company selection. And also I think the other thing with interest rates, just on that specific topic, is that we, not only do we think that our companies are relatively resilient, but also we went into this period of interest rate volatility with much more, the last few years, most of our companies have been borrowing on very covenant light terms, much less onerous conditions attached to their lending. So when you compare it back to the GFC, we think that typically capital structures are much more able to cope with that volatility and change.
Thank you very much, Colm. I think it's all quite interesting. And we'll definitely get you back on again in a year or so and see how things have been going. But good luck with it all in the meantime. So thank you for this morning.
No, and thank you, James. Really appreciate the opportunity to present the story.
Cool, thank you. So we are back next week, but we don't actually know who we're talking to yet. We're sort of keeping the slot free because we thought we had somebody lined up, but it doesn't look like this is going to happen now. But we've got a couple of reserves, so one of those will come through. So definitely do tune in, and obviously as soon as we know it is, we'll put something out on our website and LinkedIn and all those sort of places that you normally see us. So we'll let you know. And then the week after, I'm talking to John Demez about what's going on sort of utility and infrastructure. So we'll do that then. And then Octopus Renewables is the week after, 3rd of March. I think it's interesting because it's sort of European renewables. So as opposed to most things we talk about are UK focused. And so it's got a slightly different aspect. So thanks very much for tuning in today, and hope you have a good week. And we'll see you next Friday. Thanks, bye-bye.